Well, welcome to the show. I have got an amazing guest to join me today that's going to share with you step by step how she has raised millions of dollars in private money from private investors. So welcome to the show. Her podcast, which is called, by the way, How Did They Do It? So that's another great podcast you'll want to check out. But my guest today, she's a real estate investor, and her focus these days is really on investing in multifamily projects by using syndication. Well, what is syndication? Syndication, I'm actually going to let her give the definition of that. But anyway, she is in all markets all across the United States. Now, in the past, she also has experience in managing financial budgets for multi-billion-dollar projects, actually in the aerospace industry. Well, she is a working professional. She's a parent of 2 young children. And you know what? She wants to spend time with her children. She wants to see her children grow up, be a part of their growing up years. So what does she want? And what has she created? Time and freedom for her family. Well, yeah, she wants to be there for the milestones of her children. And, you know, having a full-time job can actually create a challenge as to how you make all that work together. Well, she has proven and now knows that investing in real estate syndications, yes, she's going to find that, is the best vehicle to achieve her goals. And she's going to share that with you. In other words, how is it that she has actually figured out how to have income passively and let the money do the work? Well, my guest and good friend, she's all excited about sharing her knowledge and talking about the advantages of investing in real estate syndication that does actually create that time and freedom. And with that, I'm so excited to welcome to my show, Aileen Prak. Hello, Aileen. Welcome to the show.
Hi, Jay. Thank you for having me, and what an introduction.
Well, you can tell I'm pretty excited and passionate about having you come on, right?
Yes. No, I love it.
Well, that's great. Thanks for taking time out to come on the show, Aileen. So we're going to spend a good bit of time talking about private investors, private money, private lending, the benefits of it for the borrower, for the investor, and all that. So let's start out with this, as I just said. Share, what exactly do you mean when you say syndication?
Well, syndication is really just a fancy word that just means a group investment. And so simply, that's all it is. It's a group investment where people come together, pool their resources together, whether it be their knowledge, experience, background, capital, coming together and being able to purchase something that they wouldn't be able to on their own as a group instead. And so top level, high level syndications, group investments.
Group investments. And so how is being part of a syndication as a private investor? Let's stop right there. Who is a private investor? Are we talking about institutions, banks? What's a private investor?
Well, for us, who we work with primarily are individuals. So, like myself, people who have family members, our family themselves, just individuals who are, they're working their W-2 jobs on a day-to-day basis, just average, normal people, not necessarily has to be institutions, but just individuals themselves.
Well, there's a lot of benefits to the syndicator, if you will. So in this case, of course, I believe you've done both sides of the table. You have invested in syndications, and you've also raised a lot of money from private investors for your own syndication, correct?
Yes.
Yeah. So you understand both sides of the table, and the benefits are like pretty long. So let's start with the private investor or the private, individual, the human being that wants to invest in a syndication. So let me turn it over to you, Aileen. What are the benefits? Why would an individual want to be involved in a syndication? Why do they want to invest in it? And what are the benefits to them, and why would they be interested?
Well, have you ever invested in something like, let's say, if you were to invest in something where you didn't have to put in any efforts on the day-to-day management, you don't have to deal with the tenants, you leave it to the sponsors and the people who are actually putting the syndications together to actually handle all that. So really, as an investor in these syndications, if you invest capital into this type of investment vehicle, it's really just mailbox money where your money is just now working for you. You don't have to think about anything at all. And so for a working professional or people who have family who have no interest in dealing with the day-to-day tenants, being a landlord, but still want the benefits of investing in real estate, still getting those benefits of depreciation, tax benefits that come with investing in real estate, but do not want to handle and be a landlord themselves, this is a perfect vehicle for them to be able to just invest their money and really just get mailbox money that's coming into their door.
What different types of projects do you have your real estate investors or lenders that are actually investing in this fund? What kind of projects do you syndicate that they will or would invest in?
So we focus on multifamily investing. And so what we look at are properties in like B or C type class properties in like a B type areas. So there's a lot of opportunities there to raise the rents, to improve the property, bring it up to market value rent so that you're really improving the bottom line, so your net operating income. And so that's where it's a little bit different when you're investing in a multifamily opportunity or multifamily apartment, where it's 5 units or more. The valuation of that property is calculated based off of the operating income, not necessarily the comparables. So when we're operating it, we're looking for opportunities where we can improve the net operating income at the bottom line and therefore increasing the overall value of the property itself. And so those are the types of properties that we look at where there's a lot of opportunities to bring up the value. So underperforming properties, properties that are not renting it out at the full potential of the market where the market demands it. You can renovate those properties, bring it up to a higher level, rent it out for a little bit more, and what the neighboring areas, those tenants, those residents are actually wanting to and willing to pay for those types of properties to live in.
You mentioned the asset class that you like to invest in, or what you referred to as B properties, B as in boy. So you got A properties, B properties, C properties, D properties. How about give a definition to what is a B property versus an A property or a C or a D property?
So your A properties are the ones that are, around like 10 years that they've been built. So they're pretty new. You're going to have very low maintenance on these types of properties. You're going to get those higher tiered tenants where they're, primarily higher income, and the property itself is very low maintenance because it's a newer property and it's in a really good area as well. So you're getting things like, those clubhouses, you're getting some additional amenities, a gym, you can look at the fixtures, it's a higher end type of quality. For the B classes, it's a little bit older properties, so usually between around 20 years old or something like that. You still have some maintenance issues that are going on with it. There's some room for improvement there. However, it's still a good operating property. You're typically renting to like the white collar employee or white collar residents, and so with families. And so those are the types of tenants that are typically renting in the B properties. You're still getting some good amenities, but it's not going to be as high end as the A or newer properties. And then the C class properties, you're typically renting to like the blue collar working individuals, and so you're going to be dealing with older properties as well. So there's typically a little bit more maintenance that's involved with it because it's an older property. They're usually over 30 years old or so. And so those are types of difference. So it's primarily going to be based off of the year and then what kind of maintenance is involved with the older types of properties, and then also the tenant base that are renting out those types of properties.
I know it depends on the project, but what's a range rate of return that your real estate investors in syndication can expect to receive?
So within syndications, what we like to say, especially when you compare it to the stock market, it's, you're investing in above average returns. And so you're not getting those volatile like numbers where you're able to see the spikes up and the lows down within the stock market. So it's really stable, a stable asset class that you're going to, achieve cash flow, consistent cash flow. And at the same time, at the sale of it, you also get to achieve some of the upside based off of the improvements to the net operating income. So the value and appreciation that comes along with it is also passed down to the investors as well.
So it's just not a rate of return like an interest rate, like someone would get in comparison to such as a certificate of deposit in the bank, which of course today is about 0.25% per year. So it's not only a rate of return, but are you also saying in your syndications that the real estate investor also has ownership and equity in that syndication as well, as to where when the property is turned around, improved, and sold, they get a quote unquote, as they say, a piece of the action?
Yes, absolutely. So you're part owner of the properties as the investor. You get to receive the cash flow that's coming from the operations of the property, which is typically paid out, on a monthly or quarterly basis, and that's all dependent on the different sponsors that you're working with. And then also the appreciation aspect of it. So if you're able to go and add value to the property, improve the operations down below, increase the net operating income. You can have the same types of property on the same street. However, one property may be performing much better and more efficiently than the other property. And so that property that's performing efficiently is going to be worth a lot more money than the one down the street that's probably not getting as much income from their tenants. And, they have a lot of maintenance issues and everything like that with it. So that's within commercial real estate, you're able to add value, and that's what we love about it, because we're able to do something which we call forced appreciation. You go in, improve the property, and get that forced appreciation especially at the end when you go to turn it around, because you've now improved the operations, improved the bottom line, therefore improving and increasing the overall value of that property.
So typically speaking, on average, when you invest in a project or a property and you have real estate investors come together and pool their funds, or it's a group of investors, what is your typical exit strategy? Where are you looking to go with your typical project or property?
So we like to look at around a 5-year typical hold time period for these projects. So when we look at it from a base of how much value can we add to this property? How much value can we create by operating it and stabilizing this property over X number of years? And at the same time, thinking about the exit strategy and leaving some of the meat on the bones so that the next investor can come in and still be able to add value and then improve it and then bring it up to an even higher level on their end as well. So it's like a win-win situation all around. And all in the meantime, you're improving the overall property, you're improving the overall neighborhood as well. So it's just a win-win situation for, not only the operators, but the investors, the community themselves, and the residents.
And what are some of the ways you improve the value or the valuation of the property?
So some of the ways is, so we can take a look at, some of the properties that we look at, they are the older builds. So maybe the finishes, the kitchen, they're not as up to standard or up to the newer more modern. They're not as modern as some of the different areas around them. And so we take a look at that. And typically, a resident who's looking to rent a property is going to pay a little bit more for that nicer, newer kitchen than they are going to be a dated one. And so at that point, you're able to rent it out for the newer leases to the newer tenants to coming out at more of a market rent, more market values for it. And then some of the older tenants who are in there, they're in there for quite some time. You're able to offer them a newer, better unit but it's going to come at a little bit higher cost. But most people would typically trade that value because they see the higher end finishes, to the kitchens, to the flooring, to the walls. And sometimes also you're able to bring in some additional value by, adding a dog park or a playground. You're improving the property and making it a place where residents want to live in it. And so they're wanting to pay a little bit more of a premium as well to get those different types of amenities for a better place to live.
Do you typically go in and make improvements, say to the kitchen, to the property itself before you raise rents? Or are there some opportunities to where a property is just not charging enough rents and you recognize that and you're just able to raise rents?
Yep, that's the opportunity cost as well, because sometimes there is where, you have a mom and pop owner who hasn't really taken a look at the market value and what rents are really renting out for. And so, over time, you're able to slowly increase the rents to the properties, even though you might not need to add any additional value to the property or the unit itself. But because of the market rents and what the market is renting it at, you're able to go ahead and increase that value over time as well.
That certainly makes sense. So you mentioned a 5-year period that in a lot of cases, you're looking to be in the project for about 5 years to get the value up, to get the valuation up, perhaps there's improvements and et cetera. So if a private investor is interested in investing in one of your syndications, do they have a way to get out during that 5-year period in case they have some type of emergency come up and they say, you know what, I've had something change in my life and I really need to get my investment out?
So it's all written up in front. So there's something that we call like a private placement memorandum as well. So it outlines all the risks and everything that's involved in investing in something like this. But typically within a syndication, the investment that you put in is illiquid. So what we suggest is that if you are down to your last dollar or your last couple tens of $1,000s or something like that you need for a rainy day, to not use that for the investments. It should be something, because with investments, the biggest risk of all is that all the money is lost, right? However, when you're investing in real estate, there's more, you're investing in a tangible asset. And so the fact that it's a little bit more of an illiquid investment, it's not meant for everybody. So it really depends on like your particular situation and what you're going to need that dollar for, or the funds for down the road, for seeing something, unforeseen events that may be happening in your lifetime and within those five-year period hold. And sometimes it doesn't make sense for you to invest in a syndication at all. And so it really depends on your particular situation, and if you have the capacity or the room to actually invest in something like this, because like I mentioned, it's not for everybody.
Right. Well, speaking of that, and I'm sure it will also depend on your projects, but on average, what's the minimum amount that typically a real estate investor is going to need to have liquid to invest in one of your syndications?
The average amount is typically about $50,000. Some other sponsors as well, there could be up to $100,000 minimum, but it really just depends on the project specific. But typically on average, you can expect about a $50,000 minimum to invest.
Sure, that makes sense. So our topic so far has really been speaking to a potential private investor that may want to get involved with one of your syndications to receive above average returns and get part of that action when you turn it around. So at this point in the show, let's get you to go ahead and share how people can get in contact with you to get more information about that. And then we're going to switch subjects and we're going to talk to real estate investors that are looking to raise capital for their own projects, because you got a lot of experience in raising capital. So we want to speak to that audience as well. But first of all, how would people get in contact with you to find out more information about being a possible group investor in one of your syndications?
So first of all, I would recommend that you get educated in the space. And so what we've done, myself and my partner, we've put together a resource where you can download it, visit our website. It's www.bonavestcapital.com/checklist. And then there you'll get to see, what are the types of questions that you should be asking when you're looking to invest in a syndication. What kind of questions you should be looking for to get answered by the sponsor, and some of the things about the market itself. And so for us, it's all about education, just providing information to the investors who's looking to get into this space. Because for us, our mantra, our motto is always, work actively, but invest passively.
I love it. And that website again, and that's great. I love it that you've put together this checklist for particularly new real estate investors that are new to syndication. Go to www.bonavestcapital. That's B as in boy, O-N-A, V as in Victor, E-S-T, bonavestcapital.com/checklist. That's awesome. Aileen, thank you so much for offering that checklist as, a way to get started, to get educated. I mean, that's the same way I've done on raising millions and millions of dollars in private money, is first of all, educating new potential private investors or lenders in getting involved in this space. So let's switch gears a little bit, Aileen, and let's speak directly to real estate entrepreneurs such as ourselves, like you, Aileen, like me, that want to raise money either for syndication and multifamily, or like myself, raising money, raising private capital, even for single family houses. Because you see, here's the deal. It's all the same money. It's the same money. It's just a matter of what the money is being used for. Like in my business, we've got 44 private lenders or so that loan their money on our single family house projects. But again, it's the same money used for different reasons and structured different ways. So Aileen, let me ask you a few questions on your experience on actually raising money. One of the first steps you do, you just shared, you educate people. In fact, all 44 of our private lenders never heard of private investing. They never heard of private lending. They never heard of self-directed IRAs and how they could use their retirement funds, to become involved as private lenders or syndicators or whatever. But I'm interested in asking you, where and how do you find your private investors?
So I would say the biggest help for us to be able to connect with the investors, first, before even having a conversation with them, is by starting a podcast. Same thing like what you're doing right now, is just through the education aspect of it, and just sharing the knowledge and sharing with potential investors, like what's possible out there, what are some of the pitfalls, what are some of the things that you're learning, some of the things that they should be aware of, and it's just about educating and establishing a connection with them. And so for us, it's through the podcast. You're able to speak directly to different guests on the show. You're able to share and become a thought leader in the space. And then now you've been able to, connect with a potential listener or potential investor for 30, 40 minutes at a time. You're in their ear. You're, whether it be like a weekly podcast or a daily podcast, that time they are willing and are spending their precious time to listen to you and establish that connection. So before you even have a conversation with a potential investor, you've already established a connection with them where they feel as if they know you, they know your background, they know your values, they know where you're coming from. And so the conversation becomes much more smoother as you're talking to them and getting to know them a little bit more, because they feel like they have a connection with you already. You've already established a relationship with them. And so for us, that's the biggest way that has helped us, is by creating that thought leadership platform through a podcast.
Excellent. Prior to syndication and raising private capital, did you do any real estate investing projects?
Yes, we actually started in the single family space, and we did like some turnkey projects.
So with that being the case, what did your life and business look like prior to raising private capital?
Well, prior to raising capital, we were getting loans and we were investing all with our own personal capital. And so after we discovered that you're able to partner with other people and use OPM, which is other people's money, to be able to provide opportunities to other investors and people in the space who might not have the connections that we've been able to establish in this space, and provide great opportunities that you're able to gain cash flow, achieve appreciation, or participate in the appreciation of the property as well. And also the tax benefits that come with investing in real estate. You're able to do so much more, buy bigger properties, provide more opportunities for other people as well, by raising capital, by working with other potential investors and giving them the opportunities that they might not otherwise have.
So Aileen, I got to ask you, how did you feel when you finally realized and saw and experienced the breakthrough that what you were really missing in your business to do bigger projects was private money and private investors? How'd that make you feel when you did your first deal like that?
It was incredible because it takes a real mindset shift, because if you're doing it on your own, you're going to run out of your own money. We only have a limited number of capital that we're able to utilize to fund our own projects. However, if you're able to partner with other people, it's incredible, because now the opportunities are limitless. You're able to do bigger things that you might not have otherwise thought or dreamed of being possible. And so for us, that was a huge mindset shift, to be able to partner with other people, provide opportunities. And that's the biggest thing. It's thinking about things differently and being able to provide these different types of opportunities for people who don't have the same access.
What's your favorite reason for doing business with private investors?
I think that my most favorite reason is creating those opportunities, because for us, that's kind of how we started also, was we partnered with other people who are raising capital, the same thing that we're doing now, raising capitals, because we saw as an opportunity to invest in something that we didn't have much knowledge about, the fact that we could invest it and still have our money working for us, instead of us having to work for our money. And so for us being able to see those returns, see those impact to the other investors, and how that's helping them along, and employing their unemployed dollars and having them work for them, and seeing that money being hard at work, that I think that's the most rewarding most rewarding part of working with other investors.
Yeah, you said it, Aileen. My favorite reason for working with private lenders, private investors, is that it ends up being a win-win-win scenario for so many people. In fact, I think I shared with you on your podcast, my wife, Carol Joy, and I, over the years, we've received thank you written notes and letters from our private investors, our private lenders, thanking us for changing their retirement years, that they really couldn't get this, reliable rate of return, obviously not in the local bank for sure. So it really is, I agree with you. It's just so rewarding that we're able to bring in so many more people into our business. Everybody benefits. It's win-win-win for everybody. And again, I thank you so much for offering that checklist to new new private investors in real estate at the bonavestcapital.com/checklist. But just if you would, before we close out, if you would highlight 2 or 3 items that a new private investor or private lender needs to be on the watch out for before they invest in a syndication.
The biggest one that I would say is do your due diligence, not on the deal itself, but on the sponsor, because when you're looking to invest in a private placement or a private investment, such as a syndication or private lending or whatever like that, you're really placing your bet on who's going to be operating and who's going to be utilizing your hard-earned dollars. And so that's the most important part of it, is to really do your due diligence and your checks on the people that you're investing with, because your values need to align. You need to know, like, and trust them, because it is a partnership. You're going to be, like I mentioned earlier, it's an illiquid investment. So you're not going to be able to just turn it around and say, I don't like this person, I'm going to pull it out, after a couple months of working with them, or a year or something like that. And so it's easy to just hand your money over, but it's very difficult to pull it out. So really do your due diligence on the people that you're investing with, and do your background checks, and really establish a strong connection with them, and really understand where their values are, and do they align with your goals, and are they going to help you get to your goals, your financial goals, or whatever you're looking to achieve? Is that going to align? And then the second thing is to, invest in something, and just build up your knowledge. Knowledge is powerful. Knowledge is where it's going to, make or break your investments. And so really understanding what you're getting into. And it all goes back to the sponsor. As long as they're willing to answer the questions that you have, willing to work with you, educate you, that's the biggest part.
Awesome. Fantastic advice, Aileen. Aileen, thank you so much for taking the time to join me here on the show.
Thank you so much for having me, Jay. This is really fun.
Absolutely. And again, Eileen's website, where she has got a free resource for you, particularly if you're a new private investor and you're looking to get high rates of return, or above average rates of return anyway, go to www.Bonavest Capital, B as in boy, O-N-A, Bonavest, B-O-N-A-V-E-S-T, capital.com/checklist. Download that checklist and start your education on how to get above average rates of return very safely. Aileen, it's been great having you on. God bless you, and thank you again.
Thank you so much, Jay.
You're welcome. Well, there you have it, my friend. I'm Jay Conner, the Private Money Authority, wishing you all the best. I need your help. Yes, your help. I really appreciate the likes, the shares, the subscribes. And here's where I need your help the most. If you can think of someone that you really believe would benefit from tuning into this show, be sure and share this show with your friend or family member. If you happen to be watching on YouTube, be sure and ring that bell. Thank you, Grandmaster UV, for the feedback there. Thank you for the awesome show feedback. And if you're on YouTube, as I said, ring that bell so be sure to be notified of our upcoming events. We are now on Rumble. Yes, we are. So if you happen to be viewing us on Rumble, be sure and follow us there as well. Look forward to seeing you right here on the next show. Take care. God bless. I'm Jay Conner, wishing you all the best. Here's to taking your business to the next level right now.